It is Wednesday the 18th of September. I'm your host Ryan Kia and this is the Quantium Cast. It is a really cold day to say the least. I mean, I just opened the window and I'm shivering. But that's not important. What is important is that a lot has happened over the past 24 hours. We could give an example. Oil prices have fallen 7% from their record day of around 16% of a gain. It's crazy. And those movements were as a result, well, the movement down 7% was as a result of Saudi Arabia calming fears of a supply glut and saying that actually they were able to restore their production, or will be able to, over the next couple of weeks to full production. So it'd be on 10 odd million barrels per day. So that 5 million that was feared to be lost will likely be covered. Now we need to see if they actually act on their promises. That's what we will have to look for. The inventory figures anyways come out later today. I think 3:30 p.m. for us. Those are the EIA, the Energy Information Administration figures. Those will come out at 3:30 p.m. if you're in the UK, I believe. And they are looking to be bullish based on seasonal data. But we shall have to see. I mean, I'm looking to trade along just before the EIA comes out. Try and get a cheaper price in one of the basket of stocks I've mentioned, whether it's Cairn, Gulf Keystone, whichever one presents the most value at this given moment in time is where I'll be looking to trade. I obviously hold my position in Premier. I closed a little bit, got stopped out on a trailing stop at 92, but I'm looking to re-enter that lot in and also trade a little bit elsewhere, because the higher the beta, the more the value. Am I right? But anyways, let's get into today's focus stocks. So we have the first company being Porvair Plc, the Specialist Filtration and Environmental Technologies Group. Then after that we have Image Scan Holdings Plc, a supplier of X-ray screening systems to the security and industrial inspection markets. And finally, Avingtrans Plc, a company that designs, manufactures and supplies critical components, modules, systems and associated services to the energy, medical and industrial sectors. Okay, so beginning with Porvair Plc, this is not to be mistaken with Providence Resources, which is PVR I believe. These guys have the ticker symbol PRV. As we mentioned earlier, they were a specialist filtration environmental technologies group, or filtration and environmental technologies group, and they have issued a trading update for the 9 months ended the 31st of August. And it's a very brief update, which is good for us. We're able to note that they have achieved revenue growth of 15% and on a constant currency basis 11% ahead of the prior 9-month period. Profit before tax was in line with expectations, so that's not worrying at all. It's not amazing though. They mentioned order books are healthy with a good, strong order intake in the third quarter, notably in aerospace and industrial areas. The only problem I've noted is that as of the 31st of August 2019, the group had £0.1 million of net cash. And I'm pretty sure £100,000 can't get a company worth, get ready for this, £284 million through maybe I don't know, 100k is probably a couple of weeks of employee earnings. I don't know. They've mentioned that they've invested £6.2 million in acquisitions and capex in the 9-month period. In the third quarter of 2019, they made an earn-out payment for the acquisition of JG Finneran, and that was for £2.4 million. And another group had also been acquired by Porvair for 7.7 million euros, I believe, 7.75 million euros in cash. So they're a bit tight for cash. The only thing is though, companies such as Porvair Plc with such a high market cap are able to take on debt. They don't necessarily have to go for a placing, but we could only assume that there are just cash flow issues. It's possible that their cash could improve maybe once they get payments from the end of some of their contracts. But the only worry is with some companies like this is that they may not be able to make it until the end of the contract period. But if we look at the 1 year share price performance, they've done quite well from the beginning of the year, or at least the corresponding period in 2018, the 18th of September 2018 to the 18th of September 2019, which is today. We were only going to be using yesterday's price, as we are at 7:09 a.m. in the morning, so the markets haven't actually opened. But £5.11 had increased to £6.20, which is around the 20% increase. If we're talking 52-week lows on the shares, we can see around £4 per share, and 52-week highs actually are the current price. There was no teasing action in previous days. There's quite a wide spread on the shares, and there isn't anything else from the RNS release that we can really infer, other than the fact that the company is very short of cash. I don't assume that they'll be making any acquisitions, but it could be smart to take on debt to fund some acquisitions, depending on their capabilities for, say, RCF facilities. These are basically revolving credit facilities where you can continuously take a line of credit under a specific agreement and then pay it back whenever the terms are given by lenders. But this is a much safer strategy than just placing and effectively screwing over your shareholders, because this company has delivered extremely well over previous years. I believe if we're looking at profits, their price to earnings ratio is expected to be around 30. So they are slightly expensive. It's your typical value stock where I assume they probably pay some dividends and satisfy shareholders. The only problem is that creates a potential collapse in the future. It's only one situation that is needed, one situation where the company can't deliver growth, and then you have a dive in the valuation. We could give an example of Metro Bank. They had a P of 50. They went all the way to £30 per share, and you'd be surprised to know, in fact, maybe even £40 per share. You'd be surprised to know that their share price is now £2.85 as of close yesterday, Tuesday the 17th of September. Moving on to Image Scans Holding Plc. This company is a specialist supplier of X-ray screening systems to the security and industrial inspection markets. And they have just announced a potentially large security X-ray contract, and they've also provided a further trading update for the financial year ending the 30th of September 2019. So this new contract is worth, quote unquote, in excess of £800,000. It's not really large considering they've got a market cap of £1.3 million, and £800,000 in revenue doesn't mean £800,000 in profit. They could be paying wages, they could be making capital expenditure, whatever really. Investments in technology, I mean, that comes under capital expenditure anyways. There is no guarantee that this is going to work well for them or actually materially increase their situation with the profits. And I could give an example now. Their loss for the full year 2019 is expected to be around £400,000. Assume they have a margin of 30%, because that's realistic for this kind of company. They'll still be in a loss of £160,000. So will they have to raise in the future? Likely so. And if we look at the company's shares, we can get a bit of an image from that. Allow the pun, because they're called Image Scans Holding Plc. Anyways, we look at the past performance in the past 52 weeks. Highs of 3p per share, lows of around 0.8p per share. They're currently trading at 1.05 to around 1.2 on the bid to ask spread. and that shows, yes, they have rallied a little bit, 20 to 26%. Probably a rumour on this contract. It could be possible that the market reacts positively to this. I don't really see that much substance. It's all about the numbers. But we must remember, when Fitbug released a contract that was as vague as this, well, their shares went up 10 times before suspending. But I'm not looking for a position here at all, because it's still churning cash. £1.39 million of a market cap. But they have mentioned, to kind of further the devaluation in shares, our overall performance for the current financial year has been disappointing, and we look to our extensive sales and product development initiatives to drive improved performance in full year 2019 to 20. So they've basically said this has been a poor year, and we're just hoping that this contract, along with many others, can help us. The only problem is they haven't addressed the issue of profitability. Profitability is the vital thing that keeps the company not only on its legs, but also gives it that calcium to grow their bones. But away with metaphors, we must follow only the facts, and ImageScan Plc has simply said that although this contract win was great, we are losing money, and this situation probably won't change. We hope for it to change, but it's very unlikely. So we'll take that as a very, very, as the Americans would put it, average. But I think the reaction could probably be positive, because it is such a large contract win relative to the market cap of the company, ImageScan Holdings Plc. But in the long run, this probably won't have any effect. Maybe a bump in revenues, but how much of this contract will fill, we're not sure. We'll just have to see that point. And moving on to Avingtrans Plc. This company designs, manufactures and supplies critical components, module systems and associated services to the energy, medical and industrial sectors, aka a lot of waffle, but they've got decent revenues to back it up. Growth on all fronts, gross margin up from 25.5% in 2018 to 26.7%. That's good to look at, but it's gross, it's not operating. And they haven't provided operating figures in the highlights, at least. I'll probably find them in a bit if I can. But anyways, revenue is also up by 34% to £105.5 million. In pound terms, that's an increase of almost £30 million. Impressive stuff, to say the least, from a company that to me looks like a value stock with this kind of revenue and small earnings. Cash flow from operating activities equates to around 9 million, so that's all right, considering in 2018 there was a 6.9 million pounds outflow. The only thing is, this doesn't necessarily mean a profit or a loss, but it just means that at this period they had more money in their account than they did last time where they had measured this, and that last time was in 2018, around the same time last year. In fact, for the results ended the 31st of May 2018, those were. But if we look at dividends, they've increased their final dividend of 2.4 pence per share, giving a full year dividend of 3.8 pence, up 0.2 pence in total in comparison to 2018. Their net debt is down from £7.1 million in the corresponding period to £2.0 million, so just £2 million. That is a decrease of £5.1 million, showing growth on most fronts. In terms of contracts, each individual area has delivered growth. The medical area, revenues up to £12.1 million, up by £1.7 million, which is decent. Transition to new markets is the only reason, fair enough. They've also acquired a few little companies, nothing huge. They got TechMac Inc. for literally £100,000 including costs, just trying to make their production processes simpler. Now we can also look to the energy area of their revenue model. We can see revenues up 36% on that front to £93.4 million. In terms of pound terms, that is an increase of £25 million, including the first full year of HTG results. That is amazing. Their acquisition of Ormandy made a profit in the first full year, which is decent. I don't see anything specifically negative, but I would like to find something regarding the assets. So for a market cap of £75.2 million, we can see net assets of £69.2 million. I don't specifically see profits, but if I look into the results, it is likely that they will be shown. Let's have a quick flip through, as this is a really long report, to say the least. Operating profit and then profit for the year. Okay, so the profit for the year is up from a loss in the previous period of £4.4 million. This profit stands at £2.5 million, giving them a price to earnings ratio of quite a bit. I mean, a simple calculation relative to the market cap could give us the PE of 30. It's not great, not horrible though, because they have a net asset valuation to actually back that up. They are probably valued in terms of the business at around £8 million in comparison to the net assets of say £69 million. Depends on what is there really. But it is safe. I mean, this is probably an early case value stock. The business model is a little bit more complicated, and yes, there are many different sources of revenue, but in this company's case, it is potentially worth taking the risk. I would like to look into these guys for a long-term hold. I just need to probably understand the business model a little bit better. In terms of the 1 year chart, we can see 52-week lows of 172.5 pence achieved on the 8th of January 2019, 52-week highs of 256 pence achieved on the 30th of July 2019. From trough to peak, that gives them a rise of 40%, a decent return. And you probably guessed it, with the nature of this business, reliant on a strong global economy, the reason why they went so low back on the 8th of January 2019 had been a result of the market suffering. This had been that 13% drawdown in equity markets, peaking at around 20% of a drawdown, which is a little bit scary to say the least. But if we look at the price at the beginning of the year in the corresponding period, so the 18th of September 2018, the shares were trading at £2.20 and currently are trading at £2.40 per share. So that's about a 10% return in a year, which is decent. I would find this company an interesting investment, to say the least, because they have delivered nothing but growth and they have the value to back it up. They have asset substance. Few companies can bring substance to the table, but it is interesting, to say the least, how these guys are doing. The only thing that worries me is they have really high admin expenses, £19.8 million, and the gross profits around 28 million. So after you take off all these little costs, you're left with that small figure after tax of £2.5 odd million. But if you cut down the admin expenses, imagine how much higher that profit figure could be. You could lower the price to earnings ratio, making the company cheaper by valuation metrics, industry standard valuation metrics in fact, and you can achieve so much more growth for your shareholders and return a lot more. That is something that is up to management, but sometimes with the nature of these businesses, it's difficult to reduce admin expenses, because if we look at the admin expenses in 2018, they were only about £10,000 higher, I believe. So that 10k really does make a difference, and they've probably tried to manage costs because they haven't gone out of control. There isn't much variation. But anyways, whatever you decide to do, if you're interested in going long or short on this company or any of the companies mentioned in this podcast, is up to you. We hope that this has been an informative podcast giving a couple of new names, because today's focus stocks haven't really been mentioned before. Porvair Plc, Image Scan Holdings, and Avingtrans Plc. I will put my hand up and say I've never heard of Avingtrans Plc to date, but I think this has been informative for me as well. But anyways, as always, I've got a train to catch and I've got to make sure I don't miss it, because if I take the later one, I'm going to be 10-20 minutes or so late to class. And if you haven't already, head on over to our site, quantiumresearch.co.uk. That is quantiumresearch.co.uk. You can find the link on our Twitter at QuantiumCast, and you probably can just type it in Google and it will be one of the first suggestions, because we control the CEO, baby. I mean the SEO. But I will call it a day on that note for the podcast. Until next time.